Welcome to the Deep Dive, and welcome back to Talk Tickers. This is your direct line into the most important earnings calls of the season.
And today we have a really interesting one, a total study in contrast.
We're digging into the Q3 2025 earnings for Gaotu, that's ticker G-O-T-U, the Chinese edtech platform.
And this is all about friction. I mean, You have management painting this picture of a huge operational turnaround. Efficiencies way up, losses are down.
But then you have the market reaction. The stock just sank. It dropped about 8% right after the call on really heavy volume.
Exactly. So our mission today is to figure out what's going on in that gap. We're going to pull out the key numbers from the call and then try to understand why investors are so skeptical.
What is the market seeing that management isn't? Or maybe what is management trying to sell that the market just isn't buying?
It's that classic conflict, Impressive numbers inside the company, but a whole lot of doubt on the outside. So let's start with the headlines. What did management want us to see?
Okay, absolutely. So the top line, it was strong. Net revenues hit about 1.6 billion RMB, which is roughly 223 million US dollars.
And the key part of that number is the growth.
Right. It's a 30.7% increase year over year. That's big, and it just edged out what the analysts were expecting.
And that kind of growth is really hard to ignore, especially given all the regulatory headwinds in that sector.
Yeah, for sure. But the bottom line, the profit or loss, I should say, that's where the real surprise was. It shows just how fast they're cutting costs.
So the GAAP EPS, that was a loss of RMB 0.61.
Which, okay, it's still a loss. But Wall Street was expecting a loss of around 12 cents per share, so this was a massive beat. And compared to last year, when they lost RMB 1.84, it's a night and day improvement.
Huge improvement.
Can we pause there for a sec on the loss metrics? Because people always see GAAP and non-GAAP, and I think it's important here. Why does that distinction matter so much for a company like Gaotu?
Oh, it's essential. GAAP. That's the official accounting number. It includes everything, all the non-cash stuff like stock-based compensation, for example.
Right.
Non-GAAP, on the other hand, it strips all that out. So for Gaotu, the non-GAAP net loss fell by almost 70%. 70%.
Wow.
And that number, the non-GAAP one, gives you a much cleaner look at the actual operational health of the business. It shows you how much they're improving the day-to-day running of the company.
So an almost 70% improvement in operational health, that's the story management is trying to sell. So let's dig into how they actually pulled that off.
Well, it starts right at the top of the income statement, gross margin. It expanded to 66.1%.
So that's up about 170 basis points from last year. That means they're delivering their services much more cheaply.
Exactly. But here's the number that really, jumped off the page for me. Operating leverage.
Yeah.
Management said that operating expenses as a percentage of their revenue dropped by an incredible 27.6 percentage points.
That is just, it's monumental. How is that even possible?
It really is. I mean, that's the core of their entire turnaround story. It means they've proven they can grow revenue without having to grow their costs at the same rate. The leverage is kicking in.
So the loss from operations narrowed by almost 64%. But how do you get a 27 percentage point drop? I mean, that feels like more than just trimming the fat. That sounds structural.
It is structural. And management pointed to one thing specifically: full stack AI integration.
Ah, AI, of course.
Well, yeah, but it's not just a buzzword here. They're actually using it to automate processes all across the business. And that helps in two big ways. First, you need fewer people for teaching and support.
Okay, so lower headcount costs.
And second, it makes your marketing spend way more efficient.
Right, so the AI is letting them do more with less, which hits the overhead. That must show up in the user acquisition numbers then.
It does.
Yeah.
They said their user acquisition efficiency improved by almost 13% year over year. So they're just getting smarter about how they spend their marketing dollars, who they target, and how they convert them.
And all of that smarter growth, it should be translating into better visibility for the future, right?
Absolutely. And for that, you have to look at deferred revenue. In EdTech, that's the gold standard for visibility. It's cash they already have in the bank for services they haven't delivered yet.
Money in the door.
Yep. And that number grew over 23% to almost 1.8 billion RMB. That revenue is locked in.
Okay, so let me get this straight. We have revenue growth over 30%, massive loss reduction, better margins, smarter marketing, and locked in future revenue. The stock should be soaring.
It should be.
But it sold off 8%. So here's the challenge to this whole efficiency story. If everything is so great, why did their net operating cash outflow only improve by a tiny 7.6%?
And that is the million-dollar question. That's the conflict right there.
Yeah.
It perfectly explains why the market is so skeptical.
They're still burning a ton of cash.
A ton. RMB 660 million in operating cash outflow just this quarter. Despite all the cost cutting you see on the income statement, the actual cash is still pouring out.
So why the disconnect? Where is that cash going?
It suggests a couple things the market really hates. Either they have huge fixed costs that aren't going away, or maybe their capital spending has gone up. We'll get to their M&A in a minute.
Oh.
Or they just have a bad working capital cycle.
So the market's basically asking, this efficiency is nice, but when does it turn into actual, positive cash flow?
That's the stress test.
Oh,
Exactly.
yeah. But to be fair, they do have a cushion. We have to look at their balance sheet.
A big cushion.
Wow.
They're sitting on over 3 billion RMB in cash and investments. So at the current burn rate, they have maybe a year and a half of runway. They're not going out of business tomorrow.
But investors don't want solvency. They want profitability.
They want a clear trajectory.
Okay, so let's pivot to that trajectory, the forward-looking story, because they are making a big strategic shift. CEO Larry Chen was talking about a user-centric, high-quality growth strategy. What does that actually mean?
It means diversification. They are aggressively moving into a blended learning model. Remember, the big regulatory crackdown was on K-12 academic stuff.
Right.
So now they're pushing hard into non-academic, vocational, and what they call lifelong learning.
And the numbers are starting to back that up. Revenue from their offline physical learning services was over 10% of total revenue for the first time. Why is that 10% number so important?
Because in China's new regulatory environment, having a physical footprint is all about compliance and trust. It shows you're following the new rules, and it gives customers a real place to go, which rebuilds confidence.
That makes sense. And they're putting their money where their mouth is on that physical footprint. They just finished an $80 million buyback.
And immediately launched a new one.
Yeah.
A $100 million 3-year program.
So management is basically screaming that their stock is undervalued.
They're putting serious cash behind that belief, even while they're still losing money on paper.
And then there was that acquisition. They bought a company called Zhengzhou Youai Culture Technology for about 207 million RMB.
And what did they get? 4 campus buildings. It's a direct investment in the infrastructure for their hybrid lifelong learning model. They're buying fixed assets.
Okay, so this brings us to the moment of truth, the guidance. If the market is this skeptical, management had to have put a really big, bold target out there. What did they promise?
They gave 2 clear targets. For Q4, they're guiding for about 17 to 19% revenue growth. Solid.
But 2026 is the real story.
That's the big one. For 2026, they're targeting around 15% revenue growth, and this is the headline, achieving sustainable net profitability.
Sustainable net profitability in 2026, given they're burning over 600 million RMB a quarter right now, that's tight.
It is extremely aggressive. But their argument is that the operating leverage, that 27% drop in OPEX, is just going to keep compounding. If they grow revenue by 15% and keep costs mostly flat, the math to get to profitable is plausible.
Plausible, but investors clearly didn't think it was probable. The stock dropped 8% on huge volume.
They didn't buy it at all.
Mm-hmm.
The stock is in what we call show me territory. And you have to remember, Gaotu has been lagging badly. I mean, the main China tech ETF, KWE, it was up like 25, 30% this past year. Gaotu was down.
So why the punishment? Why is the market ignoring this turnaround?
It's all about the regulatory overhang. It just is. Even with the pivot away from K-12, investors remember that crackdown. They're terrified that the rules could change again and suddenly hit these other sectors too.
So it's a credibility issue. Management is saying, look at our incredible efficiency, and the market is saying, we don't believe your business model is safe from the government, so we don't believe your 2026 goal is real.
That's the conflict in a nutshell. They want to see proof. They want to see positive operating cash flow before they'll even think about rereading this stock.
And that gap right there between the company's execution and the market's fear, that's where opportunity or risk lives. Which brings us to our next segment.
And we have to say it. This is for entertainment and analysis only. This is not financial advice.
Okay, so we see the disconnect. Great quarter, narrowing losses, an 8% sell-off. The market is pricing in zero chance that Gaotu hits that 2026 profitability goal. It's being valued like it's going to burn cash forever.
But it's sitting on 3 billion RMB. So if you actually believe management's numbers, how do you play that disconnect?
Here's the outrageous but plausible idea. You buy a long-dated, out-of-the-money call option that expires sometime in mid to late 2026.
So this isn't a stock purchase, it's a pure volatility play.
It's a pure conviction play that management actually delivers on that 15% growth and that profitability target. It's a bet on the operating leverage story being real.
Okay, but what's the catalyst that makes a trade like that actually pay off?
The moment of inflection. If that leverage keeps working, that 2026 goal is very much in play. The second Gaotu reports even one single quarter of positive net income or positive operating cash flow.
The shorts will have to cover.
It would trigger a violent short covering rally and a massive re-rating of the stock's multiple. Because it's been beaten down so much, hitting that target could easily cause a 50%, maybe more, spike in the stock price very quickly. The cash on the balance sheet just gives them the time to get there.
So it's a bet that the math will eventually win out over the fear.
That's the trade, and that is our deep dive on Gaotu's Q3 2025.
So to recap, Gaotu put up a really strong quarter. Revenue growth over 30%, expanding margins, and huge loss reduction, all driven by AI and their move into a hybrid offline model.
But the market's reaction proves that for China EdTech, good numbers are not enough. Investors need to see sustainable cash generation and an end to that regulatory fear. Everything now hinges on that 2026 profitability target.
Which leaves us with one last provocative thought for you to chew on. If Gaotu actually hits that 15% growth and sustainable profitability in 2026, which asset on their balance sheet will have been the better signal of long-term confidence? The new $100 million buyback program or the campus buildings they just bought? Which one really tells you where the company is headed? Think about that.